Okay, good afternoon, everyone, and welcome. It's great to see all of you, and we're meeting at a very timely moment for our discussion today for our periodic markets update with legendary strategist and professor here at CBS, Abby Joseph Cohen, my colleague in the economics division. Our event today is convened by CBS's Chazen Institute, which was founded in 1991. And so next year will be the Institute's 35th anniversary. It was founded by a generous gift from Jerome Chazen, who is one of the creators of apparel company Liz Claiborne. And it reflects his commitment to the idea that business education has to be approached with a global mindset. And that makes it particularly apposite for Abby and I to be here, in part because we both teach courses focused on the global macroeconomy. As the hub for global business at CBS, the Institute manages dozens of travel and experiential learning programs for students and faculty that are offered here at the school. I teach one of these on South Africa's business and economic environment. It also supports and disseminates faculty and PhD research in international economics and business, and convenes discussions such as this on campus with the broad goal of fostering intellectual exchange and deepening understanding. And we are here today to try to gain some deeper understanding of what's going on in markets and the implications, all of the volatility that we're seeing and the drivers of that volatility have for us. And there could be no better person to help us interpret, understand, and look ahead than Abby Joseph Cohen. And I have to say, on a personal note, it is always such a delight to have a conversation with Abby. Long before I knew Abby as a colleague, I knew of Abby. Abby was one of the most foresighted analysts and strategists during her time in markets, anticipating the productivity boom of the internet and digitalization of business and society through the 1990s. At the same time, she also foresaw when that enthusiasm had gone a little too far. And what was known as the Abby effect anticipated the internet bubble bursting in the early 2000s, and her call to lighten equity exposure in internet stocks and digital stocks was, by some reckoning, the beginning of the end of that boom. So Abby herself has been an influential, a leading voice in markets for decades, and it's a great privilege to be in community and in conversation with you. In her previous roles, she was a longstanding partner and chief U.S. investment strategist at Goldman Sachs when she made some of these calls. She was also president of the Global Markets Institute at Goldman, which provides research on the intersection of economics, public policy, and financial markets. She served on their partner committee, and she was a senior champion for internal disability interests and the firm's liaison to the National Defense University of the U.S. Department of Defense. In a range of roles on boards, she serves as a presidential counselor at Cornell. She chairs the steering committee for the Jacobs Technion Cornell Institute for Innovation and is a life overseer of Weill Cornell Medicine. She serves on the executive board of the Brookings Institution, the Jewish Theological Seminary, and the CFA Institute, amongst other organizations, many of which have also awarded her distinguished awards for her service. She was a member of the Obama White House appointed Innovation Advisory Board for Economic Competitiveness and is a member of the Council on Foreign Relations. She comes to us with degrees from Cornell and George Washington University. And I should note, it is not just markets that have recognized her preeminence. The media have noted she was one of the most influential individuals in financial services and rankings by Barron's, Fortune, Bloomberg, and other publications. And she has been the subject of both an HBS case study and a New Yorker profile with one of their legendary cartoons. So it is such a treat to have your insights here today. And we are just 3 weeks after so-called Liberation Day, Ruination Day in the economist's judgment. Stocks are down 16% when I looked early this morning. It may be a bit more by now.
19.
19 now. We're told markets price in things that are expected, but why have they been disrupted so much by the tariffs, the uncertainty, the erratic policymaking that we've seen over the last few weeks?
Yeah, well, Brett, first of all, thank you for that lovely introduction. Warms my heart, so I appreciate that very much. And I'm also going to begin with an apology. My voice is not what I would like it to be, but I didn't have a voice yesterday, so this is a step in the right direction. Your question, in some ways, answers itself. We have seen a policy, not just with regard to trade, but a number of other related areas, that simply has been incredibly erratic. And markets don't like things that are erratic. Whether a policy is good or bad or indifferent, decision makers, households, consumers, business leaders, and other governments like to see some sort of consistency so they know how to plan. And this erratic nature, just over the last 3 weeks, has basically torn all of that apart, number one. Number two, something that's not been getting a lot of attention here is that there are meetings taking place this week in Washington, the World Bank and the IMF. Everybody familiar with those institutions? Yeah, I'm getting a lot of nods. Thank you. And there are concerns that the United States may withdraw from these institutions, just the way the Trump administration withdrew us from the World Health Organization and from a number of other international organizations. Now just think about it. These are institutions that were created by the United States. After the Second World War, the United States took its strong position as an economy that was not damaged by the Second World War, as a nation that didn't have the sort of losses that had been seen throughout Europe and in Asia and so on, and basically said, we're going to try to create a new world that works well for everyone. That was done through these multilateral institutions in which the United States took the position, we're going to obviously benefit when the rest of the world benefits, but the US was extraordinarily generous through things like the Marshall Plan and other forms of finance and support that were provided for many, many years. What the Trump administration has done is basically tear up that whole sense of what the United States' position is in the world. So if I go back to your initial question about it's been only 3 weeks in this change in tariff policy, why these dramatic reactions? The reaction is not just to the tariff policy, it's concern about how the United States views itself and how others view the US. Because although there's often discussion about the market, the stock market down now 19%, I'm more concerned about the dollar, down approximately 12%. I'm concerned about the bond market down. Normally, the stock market and bond market, we hope, move in opposite directions. That's the whole point of a 60-40 portfolio. That's not what we're seeing. We're seeing investors around the world, including in the United States, stepping away from US-based assets. And that's a pretty scary thing. I'm going to stop and ask you to ask a really long question so I can put a throat lozenge in my mouth.
Well, that's a great tee up for a next question because we are seeing unusual developments in markets right now. As you noted, typically when equities are down, bonds provide a hedge against them, and the US dollar is a safe haven when we see volatility in markets. In this case, US equities are down, bonds are being sold off, and the US dollar is down. Right. What are markets telling us?
Markets are telling us that they have very little confidence in this administration. Now, keep in mind that on January 19th, the US economy was viewed appropriately as the strongest and most robust in the world. Economic growth in the prior quarter was about 3%. Core inflation was just about 2%. The unemployment rate was at extremely low level. Job creation was robust, and corporate profits were at a record level, not just in terms of dollars, but in terms of return on equity, ROIC, and so on. Things look good. Here we are just a few weeks later, and we have seen this reversal in expectations. On January 19th, if you go back and look at some of the macro forecasts, the assumption that there would be a recession in the United States, depending upon the forecaster, was between 0 and 15%. That number is well above 50% now, and there are a number of established forecasters who put it at 65% and higher. That's an awful lot of damage in a very short period of time. And we keep talking about the erratic nature of the decision-making. Well, let's strip away the volatility and the fact that we say one thing on one day and the administration says another thing the next day. Let's just take a look at where the policy is. This is not good policy. The trade policy in place right now is among the worst I have ever seen in my career. Now, I take it back. It is the worst I have ever seen in my career. And let's clarify something. The media would have you believe that when the White House reversed its stance on those so-called reciprocal tariffs, everything was fine. Things are not fine. Because what is in place? There is still a 10% universal tariff, and the tariff on China, I don't even know, is it 135%, 145%? Not quite sure. And so people who are, shall we say, not really looking at the economics carefully are saying, oh, it's only a 10% tariff, and we had a 2.5% tariff on average, and so it's only gone up 4 times. No, no, no. The average tariff now is about 20% if you weight it by the countries with whom we deal and the tariff rate which has been applied. So we're now talking about a tariff that will be paid ultimately by US consumers of 18 to 20%. This is a huge tax increase that will fall very heavily on middle-income Americans. And to me, this represents an absolute mistake. Not only will it slow down economic growth, it will also boost inflation and be very problematic. And hence you have this dilemma being faced by the Federal Reserve. Do they keep interest rates high to offset this self-imposed inflationary consequence? Or do they lower interest rates to offset the self-imposed slowdown in economic growth? I would say that this war of words that Mr. Trump is having basically with himself with regard to what Mr. Powell is doing is a way of the Trump team finding a scapegoat ahead of time for what I believe will be a very bad economic outcome.
And Chair Powell himself recently referred to this as a challenging position.
Yes.
What are the particular challenges of this position, and how can he reconcile them or mitigate them?
Okay. Well, as Brett knows, I started my career at the Federal Reserve Board in Washington. And although I was a junior person, like many others, I have been an avid Fed watcher for many years. And I would say that Jay Powell has been very, very careful in all of his public statements. He has said nothing that would inflame most presidents. But I believe that Mr. Trump, as I mentioned before, is looking for a scapegoat. So whatever Mr. Powell says, Mr. Trump is going to find something to object to, number one. Number two, Mr. Powell is not the only one who sets policy, right? The entire FOMC has many voting members, and there seems to be, based upon their public commentary, unanimity in terms of their approach. The thing that has surprised me over the last week or two is any number of the Fed presidents and other members of the FOMC, the voting members, have made public statements that have been very consistent with Mr. Powell. So he is not alone. And I think that they're all feeling this incredible challenge. And in the past, we would call this challenge stagflation. That is stagnation of the economy where it's not growing the way you would like, plus inflation. And what do you do? And what is different about this go-round is that this is all self-inflicted, right? This is a function of policies that have been imposed upon the economy. The prior stagflationary period, which occurred 30 years ago, was related to a sharp increase in commodity prices. OPEC had a boycott, there were rises in other commodity prices, and so there was an underlying global inflation that the Federal Reserve needed to respond to. This is very specific, where the US government has imposed upon the US economy an 18 to 20% sales tax. I don't know how to be more direct in how I describe this.
Now, given that that has been imposed, and we've seen in the Michigan survey a huge increase in inflation expectations, on the tools that the Fed has, do you think that makes it incredibly unlikely now that they could cut their policy rates when that big increase in inflation expectations has essentially pushed real rates down so much?
Right. I think the Fed has an enormous problem, and I'm glad I don't have to cast a vote, quite frankly, because I think it is a no-win situation for the Fed. The Fed normally looks at existing levels of inflation, but as Brett points out, they also look at expectations, because what you need to do in an inflationary period is control not just current inflation, but to tap down those long-term expectations, because it's those long-term expectations that really do drive inflation. What do I mean by that? If everybody thinks that the price of some good is going to go up in a month or two or three, people run out and buy it now, right? So it basically is a self-fulfilling prophecy in terms of what happens with inflation. And the thing that is so troubling and disappointing is that inflation expectations were quite low just a few months ago, even though people were concerned about the price of eggs, which was related to avian flu and not a policy mistake. Those long-term inflation expectations a few months ago were quite low. Now we have a situation where even before inflation has begun to kick up in response to tariffs, we see that the inflation expectations have moved dramatically higher. But something I'm even more concerned about, Brett, is what happens to middle-income workers when they realize that not only is inflation up, but their job prospects are down. Because the people who will be most afflicted, in my view, by these policies will be the people who basically have those middle-income jobs where companies are deciding right now to be frozen in place. We see that companies are not doing CapEx, they're not hiring new workers, and the next step is to start to reduce their workforce. Now, it's not going to happen right away. Why? Because we have all of this anticipatory action in the economy right now. If you're running a business and you know that tariffs are rising, what do? Well, you build up your inventory, right? You do that as a business person. If you're a homeowner, you might be doing some anticipatory buying as well. Perhaps you've decided to put in place that new washing machine or that new refrigerator. If you are a home builder, we see evidence that imports from Canada, where we get a lot of that lumber, have increased and so on. So we're in this, I'll just call it an interregnum period, which could last a few months before we see the true impact of these tariffs on inflation and on aggregate demand. And so I would urge you, and I'm a data wonk, okay? I would urge you to ignore short-term data because it's going to look better than it is. It's going to be masking some of these intermediate and long-term concerns.
So looking at those intermediate effects, are there particular sectors that you think may be more adversely affected by the policy uncertainty and actual shifts going on, and some that might be more insulated? Particularly thinking about the career leitmotif that sits in the background of our discussion.
Right. As Brett and I discussed earlier, neither one of us are career counselors. And this situation is made even more tenuous right now because we don't know how this is going to play out. I'm going to give you one example. If you had asked everybody 2 weeks ago which sectors were going to be the most afflicted by the tariffs, people would have said consumer electronics because of the tariffs on Chinese product coming into the United States. And then lo and behold, the White House gives a pass to Apple and gives a pass to a whole other bunch of consumer electronics companies. So I don't know who else is going to get a pass. Do I look at donors to this White House and make that determination? Or are these exemptions being done on the basis of economic impact? Don't know, because we're not seeing the kind of transparency that we might like in terms of how these decisions are being made. I'm going to say one thing that may sound a little unusual, and I'm going to change the subject just a little bit and move away from tariffs and talk about what's happening to government employment in the United States. Some of you who've been to these sessions before know that the last time we did this in the autumn, around the time of the election, I indicated that one of my single biggest concerns, in addition to tariff policy, was policy around government employment. And I particularly identified something called Schedule F, which was mentioned in Project 2025. Anybody here know what Schedule F is? One person, thank you. 2 people. In the autumn, nobody knew. So let me tell you what it is. Schedule F is a plan, which is now in the process of being implemented, in which senior level civil servants, that is the non-political appointees in our government who are working at the highest levels, their jobs are reclassified as political. So you take the scientists and the experts in any number of categories, and you change their jobs from being one where you look at their credentials and their experience, and their jobs are reclassified as political appointees. Now, I believe that every president, whether I agree with their policies or not, is entitled to their political appointees. Normally, those are the people who run the agencies. There are something on the order of 10,000 of those political appointees. What we're talking about is the next 50,000 down. The people who actually do the day-to-day job, run the agencies, do the scientific work, make decisions about where the government will be investing in science and engineering and so on. Those jobs are now in the process of all being converted to political appointees. So in addition to whatever you've heard about people losing their jobs, you now have 50,000 people who will be subject to dismissal, not because they've done something wrong, but because their jobs are now political appointees. If you go back to the 19th century in the United States, we used to call this the spoils system, right? To the winner goes the spoils. And it used to be that every time there was a presidential election, jobs in the US government would switch over to people who had been politically helpful to the winner. And that was changed in the United States in the early 20th century by Theodore Roosevelt, who basically said this is no way to run a government. Mr. Trump is the first one to switch back to this other system. And one other point, if I may, you may have heard about all of the so-called probationary workers who have lost their jobs. And that gets presented as, well, these are the newbies, these are the rookies. No, they're not. Many of them are relatively new hires. That does not mean they are inexperienced. Many of the people who get hired into the federal government civil service are coming from industry or academia because they have incredible expertise, but if they haven't had those jobs for more than 2 years, they are probationary. Also, somebody who's a terrific performer in the US government and has just gotten a promotion, let's say pretty high-level civil servant, and they're going up to the next level, they are also counted as probationary because they are new in that position. So as all of these so-called probationary workers are being dismissed, keep in mind we're also dismissing a huge amount of expertise from the government, and this worries me a great deal. I think what is happening is everyone's focusing on tariffs. They're not focusing enough, in my view, on some of these other things that are going on.
Well, pulling together some of those other things, and this will be a last question from me so that we can throw the questions to the audience. The combination of tariffs, erratic policymaking, changes in the politicization of the public service, immigration changes, are these all having the effect of unwinding what has been called American exceptionalism, which certainly manifested in the last year or two in an incredibly crowded US equity trade, but more broadly over decades in the creation of Pax Americana?
Yeah, that's a wonderful question, and I am concerned, and by the way, I did express this concern in the autumn as well. So let's talk about where we are in all of these different categories. Part of the secret sauce of US growth, whether we use exceptionalism or not, I'm not sure I love that term, but why has the US economy been the most successful of the developed economies for many decades? One reason has been our workforce, a critical reason. The US economy has benefited from faster growth in the labor force than any other developed economy. And by the way, much faster labor force growth now than China, Europe, Japan, and so on. Why? I know that there are some people talking about, well, we have to encourage women to have more babies, et cetera. Well, the reason for the growth in the US economy and our workforce has been that this has been a nation that has welcomed immigrants. Our native birth rate is about 2.5%, but our workforce increase has been more than 3% because we have welcomed immigrants. And part of the policy that we are seeing play out is we're discouraging immigrants. We're discouraging international students. I hate to say it. I can spend much more time on this, but I want to get to the other points. And this to me is very worrisome because if we are no longer viewed as a place where high potential, high achieving people want to come, that's not good for the United States. Second part of the so-called exceptionalism, I'll just call it the better and stronger economic growth, has been that we've invested in the future. The United States has been the #1 investor in basic science and R&D for 125 years. Basically starting at the end of the 19th century, the United States and the federal government was a critical part of this, invested in scientific research. And after the Second World War, the model became that the most effective way to do that is for the federal government to provide the funding, but to give it where? To give it to universities. Because universities and medical schools would be more creative in terms of the way the monies would actually be spent. This is not a bug of the system. This was a feature of the system. It was specifically designed because the United States had been spending money, but not as effectively as European economies were. And so this was the European model that was being followed. One of the things I'm worried about right now is the war that we're seeing directed at various universities, particularly the nation's research universities. And while lots of the conversation has been on the private schools, including Columbia, there has also been grant withdrawals from state universities in the United States, which makes absolutely no sense to me. One of the great strengths of the US university system has been not just our wonderful private schools, but our wonderful, what we call land grant or public institutions, where we have been able to educate many people who otherwise could not have afforded it. And these schools are, in fact, much more dependent on the percentage of total on federal grants than are the private institutions. So I've discussed labor force, I've discussed science. What were the other things that you wanted me to discuss?
Tariffs, erratic policymaking, and Fed independence, really wrapping everything we've touched on together to sort of point ahead to where we stand.
All right, so erratic policy, I think that we've addressed quite well, but even if you strip away the volatility and look at the policy in place, a lot of it doesn't make any sense to me. And I'm going to finish with this. Assume a can opener. Okay, anybody know this joke? Assume a can opener.
It's the economist's favorite party trick.
That's right. Okay, so I'm going to give you the short version of it. An economist is shipwrecked with 2 or 3 of his buddies. They're all guys, which is why they can't figure out what to do. All right. And they're on an island, and they have no food. And all of a sudden, they discover a can of soup. And they're trying to figure out how to open it. And so the mechanical engineer or the physicist, however you want to do it, says what we need to do is to find a rock and hit it at just the right angle, and the lid will pop off. And the economist starts smirking, and he says, that's not a good way to do it, because when you hit it with a rock, some of the soup will go out. And everybody says, okay, now what do we do? The chemist looks at the can and says, well, if we heat the seam right here, we'll take advantage of the fact that the lead on the seam basically has a different boiling point than the rest, and the seam will open and we'll get the soup. And again, the economist is smirking, and he says, you're going to spill too much soup. I'm giving you the short version of the joke. And everybody says to the economist, okay, what do? And the economist says, assume a can opener. That's the joke. And what I would say to you is that that's what this administration is doing. The tariff policy that they say they're trying to aim for, to my mind, is assume a can opener. If somebody gave me the paper that they're all referring to, I would give it kind of a C-. Doesn't hang together. It's creative.
That's the Stephen Mirren paper.
That's right, the Stephen Mirren paper. I didn't want to be too critical. But to me, it doesn't hang together, and it's theoretically, it may hang together, assume a can opener, but it doesn't hang together in practice.
So thinking about what works both in theory and practice, I'd like to throw the floor to you. I think there are mics on the side, so if you have a question, please put up your hand. The mic will get passed to you. Please introduce yourself and pose your question. Really, the entire terrain of what's going on in markets and the economy are fair game, so don't hold back. Yep, up front here, Felipe or Frank.
Thank you very much for coming. My name is Felipe. I'm a second year from Brazil. I have 2 questions. When I hear from people that defend what the administration is doing, what they mention is that the environment that we had before was, in a sense, fabricated and destined to fail at some point. And so, do you think that that there's any merit to this side of the story and what they're trying to do and like managing the 10-year term?
Which aspect are you referring to as being fabricated? I have my own list, by the way. But
mostly long-term debt. That's I think like at the center of what I hear in this argument.
Okay.
So that's my first question, and the second is: do you think it's possible that we'll live in a world where there's no risk-free rate or no risk-free asset?
That's a great question. So with regard to fabrication in terms of there being long-term debt, yes, the United States has a great deal of long-term debt. The right way to look at it is as a percentage of GDP, because you're trying to look at it relative to ability to pay. And so it is something that one could argue the budget deficit has been large and growing for a long period of time. But over the next few years, it becomes more and more difficult to pay it, particularly if labor force growth slows. So you have fewer people paying taxes, including Social Security taxes. You have more people in my generation who are retiring and become Social Security beneficiaries. You have more people on Medicare and so on. So yes, that is a real issue. What has been proposed thus far does not address any of this, because what we have seen going through the Congress, the Republican Congress, one presumes it was approved by the White House, actually would make the deficit dramatically larger. And if we're talking about a mirage, they made $4 trillion of debt disappear in this calculation. How did they do that? They basically made up a construct in terms of budget plan. So normally you look at where the budget is, you use that as the baseline. And here, again, they had said, assume a can opener. You know, assume that the tax reductions that were put in place a few years ago and are supposed to disappear, assume that they were really permanent all along. It's not true. It's assuming a can opener. When I look at the parts of the economy where I worry long-term, one is the deficit. But we have a few years running room yet. We're getting closer and closer to the point where it's problematic. I'm concerned about the unequal distribution of income and wealth, which has become more and more unequal. Part of that is related to the tax policies that are in place, but part of it, and this is where one argues that the tariff policy might be able to help, but not the way it's been implemented, is that middle income people have fallen behind. They did fall behind. For 20 years, the middle income household, the median household in the United States, adjusted for inflation, didn't see any improvement, even though upper middle income and upper income households did quite well. However, that changed during the last 4 years. During the last 4 years, there have been wage increases at the middle income level that have notably exceeded inflation. So the median family was actually doing better. The argument in favor of some of these tariffs is that you will recreate a better environment, or you will create a better environment for average workers in the United States. And the way I look at it on a sectoral basis is no, you won't. What they're trying to do is to recreate the manufacturing strength of the United States, when we have to recognize that most of the manufacturing jobs that were lost not due to trade, they were lost due to productivity and efficiency. Okay? Think about this for a moment. Analysis that have been done by people who are strictly apolitical basically would say that about 80% of the jobs that were lost because machinery and greater efficiency. 10 or 20% related to trade or unfair trade practices. Do I think unfair trade practices need to be addressed? Absolutely. And by the way, they were addressed during the Biden administration. What do we need to look at? We need to look at whether a country is dumping, all right? In some categories, China is producing stuff in excess of global demand for whatever it is. For example, solar panels. That's not acceptable. And then to sell them around the world at below the cost of production is not acceptable, and an appropriate use of a tariff. Another appropriate use of a tariff is when there are national security interests. I think we discovered during COVID in particular that when supply chains are so heavily dependent on one country or one other country, that's just not a great thing. And so whether it is medical equipment or semiconductor or whatever, it needs to be addressed. The CHIPS and Science Act during the Biden administration was aimed to do that. Billions of dollars have been invested in new semiconductor fabs in the United States. In Arizona, the world's largest new fab, even in upstate New York. And so the idea was to reduce dependence. Now, you can't reduce dependence right away. It takes several years to build these facilities. So in response to your question, yes, there are problems in the US economy. Yes, they need to be addressed. I don't think that the policies I have seen thus far since January 20th address those problems. They address other things, but not the problems that I see in the economy. This gentleman in the gray t-shirt, gray sweatshirt had a question.
Frank?
Let's ask, oh, I'm sorry, I'll get back to the risk premium.
Mm-hmm.
Thank you. I guess the question that I had is with capital, there's been a fear that capital from international investors is fleeing the US, and you mentioned about the dollar.
Mm.
And as that affects, valuations for companies in the US stock market, I think every company's impacted to some degree by the trade war and tariffs and whatnot, but some have like such secular tailwinds that they can power through it to some extent over time. Do you think that even if international investors flee, like a floor will be set because, just to say, like an Amazon, for example, as it falls in value, you have, U.S. investors who might finally be tempted to buy it at an attractive valuation, like a Gabelli or someone else. So do you think that kind of will even out to some extent over time? Or is that the international investors leaving introduces so much damage that it can't be offset by domestic investors?
Okay. Let me combine the remainder of your question and this one, because they both relate to valuation of assets and demand for assets. And your question specifically earlier was about, will there be a risk-free rate? No, the US Treasury has always been, since actually before the end of the Second World War, has always been viewed as the benchmark for the world. I don't want to call it totally risk-free, but the most riskless of assets. And one of the things we're seeing now with the bond market selling off, even in the anticipation that many people have of potentially a recession, there's obviously concern about the prospect for the dollar and for US Treasuries. And it's not just the economics. It's also comments that Mr. Trump has made in recent years about, well, why shouldn't we default? This is not helpful, right? The US Treasury is viewed as the riskless security because the US government never defaults. And yet you have a US president saying, well, why shouldn't we default? You also have a situation where the United States is taking it upon itself to withdraw from aspects of the international financial community. That is not helpful for the dollar or for the prospects for the bond market. Now, I don't know how this ultimately plays out. I'm hoping that someone in Mr. Trump's circle of advisors convinces him, as he was convinced in his last term, that some of his commentary is not helpful. And some of these proposed actions are also not helpful. But I don't know how this plays out. And as I mentioned at the outset, maybe we'll know more by the end of this week when we see how the IMF World Bank meetings turn out. By the way, I'm going to be spending the next couple of days meeting with some of these government officials who are headed down to Washington. And the requests for these conversations range from Europe to East Asia to Oceania, because people are just confused. And these are very senior government officials. And what they want is sort of a read from New York about how the financial markets here are perceiving what's going on in Washington. So the second question from you has much more to do in some ways with the equity market. I am, at the end of the day, a quant, right? I have built many models in my day, and what I know is that the models are most helpful when the model builder sits back and says, what did I miss? what could go wrong? What haven't I built into the model? And if I was just to look at the models right now, I would say, we're sort of approaching, again, a fair value level. We were overvalued in January when everybody was so enthusiastic about everything. We have now kind of like come down through fair value, and one could argue some sectors are undervalued. However, there is worry on the part of investors, and this goes to the question of risk premium. Do we really know what the right risk premium is? And there's always the risk premium that's built into the market at any time, and then there's the required risk premium. And I would say that whenever you have erratic policy, and as a consequence, you have an economy that you just don't trust, and here I'm talking about the world economy, you demand more. And if this was not an audience at the Columbia Business School, the way I would present it is when people are happy, as they were in January, they're willing to look far out into the future. They're willing to give you credit, if you will, for the next 2 years of earnings or the next 3 years of earnings, as was the case for a lot of the AI-related securities. But when investors are confused and nervous, they're not willing to look that far into the future. And I would say that before the tariff announcement 3 weeks ago, investors were willing to look a quarter or two into the future. Now they're not even willing to look into last quarter. They're not even willing to pay for what they know happened with certainty. So you tell me what that means for the risk premium, right? You should all know the answer to that. But if this were a general audience, that would be the way I would describe it.
And is the US bid on equities big enough to replace an outflow from foreign investors?
The answer is an interesting one. Normally we view the US equity market as being domestic, right? Because, depending upon, quarter we're looking at, 85, 90% of our shares are owned domestically. However, a larger percentage of our bonds are owned internationally. There's treasury bonds, corporate bonds, and now private credit. And I'm concerned about that because if you have a sense that they don't trust the fixed income markets, they can withdraw, which may explain why the dollar has been doing what it's doing, because how do most non-Americans invest in the dollar? They invest through the credit markets. And so ultimately that impacts valuation. So if interest rates are going up, even though equity outlook is going down, it makes the valuation argument harder and harder to make.
Over here.
If we continue to see investors losing trust in US dollar asset and also US treasuries, how do you think will the possible new monetary system play out? Will it be possible, and how would it be like?
Yeah, I had a conversation not that long ago with somebody who I consider to be a great expert on currency markets, which I am not. And the individual is Eshwar Prasad. Eshwar is kind of my guru on currency. He is a senior fellow at Brookings. He's a professor at Cornell. He was in charge of a part of the economics section at the IMF for many years. He's a really solid guy, and I presented exactly that question to him. And he said, what's the alternative to the dollar? What's the alternative? And I know that we always like to think about, well, if it's not the dollar, could it be the renminbi and euro and so on? And let me make a couple of factual points and then talk about what I think the answer is. We know for sure that the Chinese have been very proactive in encouraging contracts to be written in renminbi, right? So if I go back to the beginning of the pandemic, 90% of the contracts in Asia were done in dollars. Only 10% was with the US, right? So everybody's using the dollar because of commodities, and it was just the currency. When you are the reserve currency in the world, things just get done that way. And what the Chinese have insisted on with many of their regional trading partners and some of their commodity providers is to do the contracts in renminbi. So clearly there has been an increase there. We also know that within Europe, there has been some movement towards doing more and more contracts in euro. So shouldn't all of that mean that you're going to end up with a basket? And the answer is, according to the people I speak to, who are experts in currency, is that not yet. Because the renminbi, even though it's becoming more important as a commercial currency, is not free-floating, right? It's still, the value is still driven by the government, and you cannot be a reserve currency if that's the case. You also can't be a reserve currency if you have a huge trade surplus, right? I hope you've all taken the course here that shows the mathematical tautology that for a reserve currency, you are basically always going to run a trade deficit, right? That's part of it, right? So, you know, it's kind of, again, assume a can opener. It's kind of laughable to me that one would expect the nation with the world's reserve currency to have a trade surplus. It doesn't work. That's not the way the numbers work. It's an accounting tautology. And so I think for the time being, we're talking about the dollar still being the world's reserve currency. We have seen it down, you know, let's call it, I don't know, 10, 12%, maybe a little bit more today, because today's not a good day for the dollar. But that does not mean that we're set up for the renminbi to take over or for the euro to take over, at least not yet. By the way, I am hopeful. I have no confidence in this, but I am hopeful that the US will move towards a more sensible policy and to do it sooner rather than later. I think we need to move away. I was going to say ideology, but it isn't even ideology. A lot of this stuff doesn't really hang together in a theoretical sense. It's just being thrown out there. And I'm hoping that cooler heads in the administration are able to cobble together something which makes more sense than what we have right now.
What does the off-ramp look like?
The off-ramp for what? From,
you know, the so-called reciprocal discounted tariffs, from, you know, the threats to the Fed's independence. How do they retreat and still declare victory?
Yeah, I don't know. That's the honest answer. But let me take a couple of stabs at it. With regard to the tariffs, I hope that other nations will in fact come and have conversations, and that those nations that have had some unfair trade practices with the United States will adjust them. Here's the dilemma. Mr. Trump tore up the trade pact that he cobbled together with our most important trade partners, Canada and Mexico. That trade pact that he keeps railing against is one that his administration put together and one that he was so proud of. And so if you ask other nations to step up and negotiate with the United States, there is not that much confidence in the word of the United States. You know, we have always, in this country, honored our treaties. I can give you a couple of examples. That's not the case, but we always try to. And when there was a change in administration, it didn't matter because it was legally bound. The country was legally bound to abide by those treaties. What Mr. Trump has been doing is basically saying, it's a treaty if I say it's a treaty. That doesn't breed confidence. So when we talk about what could be done, I could see that the trade situation gets resolved, not within weeks. It would take months, if not a couple of years or longer, to work this out with all the countries. But there has to be a sense of less erratic behavior in that regard. In terms of the commentary on the Fed coming from the White House, it is the president himself who is creating the problem. And I don't know what happens with regard to it. By the way, Jeremy Siegel, professor at Wharton. Some of you probably have read some of his books and so on. I once wrote a blurb for one of his books. Jeremy said this morning on CNBC that he thought the best thing for Jerome Powell to do was to lower interest rates. And when asked to explain, what he said was, number one, the way he interprets the economic prospects in recent months, it's very worrisome. As I suggested to all of you, the current data, you really can't tell how weak things are under the surface. But what Professor Siegel is saying, oh, you know what, it's going to be weak. So the Fed should lower interest rates for that reason. And oh, by the way, if they do, then maybe Mr. Trump will stop breathing down their necks. So he thought that one of the things to do to maintain Fed independence was for them to lower interest rates at this point. The problem is that if they do that, it will look as if they caved in to the political pressure. So the expression you used before, Brett, about the Fed is challenged right now. The Fed is challenged not just by the economic circumstances, they're challenged by the political circumstances and also the communication conundrum that they have.
We have time for one last brief question. In the middle here.
Hi, thank you so much for coming and speaking with us. I'm Jessica, I'm a first year. With Powell's term being up in May 2026, I know that seems like ages away. Do you envision more volatility in markets and more questioning of Fed independence? Who do you think is slated to replace Powell, and what do you think the impact of that could be on markets?
Wonderful questions that I can't answer. I can't answer them because at the end of the day, it is the president's decision in terms of who he will nominate. I think it's pretty clear that Mr. Powell will not be renominated, even if everyone else thinks that he's done a great job. And the reason I laid out early on, and that is he's the designated scapegoat. So whether he's done a good job or a bad job, he's the designated scapegoat. So by washing his hands of Mr. Powell, Mr. Trump can say, wasn't me who did it, somebody else was responsible, number one. Number two, normally we would look at some of the well-regarded members of the FOMC as a potential follow-on. And there are a number of very good people, and as I mentioned earlier, few of them have been stepping up the last 2 weeks or so, speaking publicly. Austin Goolsbee, for example, spoke at the Economic Club of New York here just last Thursday. I was supposed to be the interviewer, but I had no voice, so I didn't do it. But he's also been on CNBC, MSNBC, and he was on, I forget now if it was Face the Nation or Meet the Press. So, he has a very significant public profile, as do a handful of the others. And basically, they're all out there trying to sound reasonable. I think, however, that Mr. Trump will do something different than what he did in his first term. In his first term, he appointed Jay Powell because Jay Powell was viewed as somebody with steady hands, somebody who understood the economics, but also understood the business community and was well regarded by the business community. I think just looking at the other nominations for other positions that Mr. Trump has made, I think it's more likely that he will pick somebody who has a political connection to Mr. Trump. Mr. Powell did not, but I think whoever is selected next probably will.
Well, like all macro conversations, this could continue. I want to thank Abby for joining us today, and I'd like to ask you to join me in thanking her for sharing